Hello everyone. Can you hear me well? Yes. Okay, perfect. To tell you a bit about the program today, I'm going to first try to do a bit of education on reminding you what is a structured note. We'll go over the main benefits, the things to keep in mind. I'll give some examples so we can talk about concrete things. We'll talk about the global recession. You know, Igor did the Brexit thing. I'll do the global view. And then we'll talk about how we work with Prashant together and to you then. And of course, we'll talk about what we've done so far. So to start, let's talk with the basics. How to invest into a listed company. And what do I mean by a listed company? A listed company is a public company trading on a stock exchange, okay? When you want to invest into a company, you have several options. The first option that comes to your mind is you want to buy the stock. If you buy the stock, you have equity ownership. If you do so, it's because you think that the price of the stocks will go up. But what if you are wrong? The problem with stocks is that it's very volatile. You take the full risk when you buy a stock. The second problem is you might be buying the stock for the dividend because you like the dividend that is paying by the stocks. The problem with the dividend is like it's not guaranteed. A company can decide to cut or to reduce its dividend, and they won't ask for your opinion. The third problem is market timing, because we are not Warren Buffett. When we buy a stock, the entire market is not following us. So market timing is very important. You might be buying a stock today, tomorrow there is a profit warning and the stock drops 12%, and there's nothing you can do about it. The second option is you want to buy the bond, and if you buy the bond, you take debt ownership. Issues with the bond is it's generally with low income. The rates today on the international market are pretty low. The high minimum as well. Most of the bonds that you find on market have a minimum trading size of 250,000 for one bond, so it's pretty high minimum. And they are long maturities, 5 years and above for most of them. And you also have the risk of rising rates. In the current environment, internationally, rates are pretty low, and they might be rising in the future. Maybe not in the near future, but on the long term, if the rates are rising, your investment into the bond will be suffering. So the question today is, what if we had a third option? And you see me coming. The third option will be structured notes. If I had to describe what is a structured note in one word, I would be using one of them. You see what I mean? It's everything customized, tailor-made, bespoke, whatever you call it. It's done according to a need. It's a little bit like the scene I'm on today. This scene, the shape of this scene and the stage has been done just for the 29K event. It's been customized for them. They had some wishes, they had some thoughts, and they designed it for it. Structured note is the same thing. The product doesn't exist at the time we speak. We're going to create a product to answer the investor needs. So what is it? A structured note is a financial instrument aiming at investing into an underlying. What is an underlying? It could be a stock, it could be an index, an ETF, a commodity, a currency, a fund, anything that is listed on the market. Okay? That's number one. Number two, it's a mix between a stock and a bond. A structured note will be issued by a financial institution, and in that sense, it's a bond. But the performance of the product will be linked to a stock, and that's why it's a mix between both. It's an alternative to direct investment into the underlying. What do I mean by that? The underlying that you're going to be invested in is the exact same underlying that you would be buying on the market. So if you buy a structured note linked to Microsoft, for example, you would be buying the exact same Microsoft stocks. It's not like, like an interpretation or like a synthetic replication. It's the real stock. So you follow and you track the exact same stock. Number four, it's a financial contract. There is no human bias. What do I mean by that? When you buy a structured note, everything will happen the way it's written in the contract. The only uncertainty is what is the underlying going to do on the market. If we take Microsoft as an example, the Microsoft stocks will vary, day after day, but the contract of the structured note is guaranteed. That's going to behave exactly the way it's written. So it's giving you comfort to understand the rules and the frame you're investing in. Number five, it's a truly investment solution. And I put the word solution in bold because we are trying to find a solution to someone's needs. Okay? When you express your need to your financial advisor, you're going to tell him, I'm looking to X% return. I would be comfortable with downside protection if the market drops. I cannot lock the money more than 3, 4, 5 years. Okay, so we're trying to find a solution to someone's needs, and that's very important. So what are the main benefits? Number one would be to say that the regular income stream will be given by the structured note. So you might be investing into a stock that doesn't pay a dividend, but you can still generate income thanks to the structured note. The number two, it's always meeting the investor needs. As I told you, it's creating accordingly. So the structured note shouldn't be bought when it's already existing. If it's a note that is already existing, it's answering someone else's needs. Better than direct investment into the underlying for main three reasons. The first is downside protection. When you buy the stocks, you don't have any downside protection. The structured note will be providing you with downside protection on the market. The currency hedge. This is something which is very important for international investors. Today, if you invest into a European company listed in euro, you do not have to invest euros. You can invest US dollars. You can invest British pound. Okay, the currency hedge is embedded in the product. Number three, basket of underlyings, and this is also very important. I took the example of Microsoft, but if you don't want to limit yourself to Microsoft, you can also invest into a basket of different companies, and you can create a basket of, I don't know, IBM, Amazon, Google. You can create a basket of underlyings. You're not limited to one single underlying. The access to certain markets, this is more specific, but to give you an example, we can do a structured note linked to a commodity, whether it's oil, whether it's gold. It does not mean that Prashant will be holding gold bars or barrels of oil in his office, but you can get access to this market and the real market, so you will be tracking the exact price of oil or gold. Bond or stock, you don't have to choose. The structured note is providing you the best of both worlds. An affordable solution. You remind you what I told you about the bond. The minimum is generally $250,000 for one bond. We can issue a structured note as well for $250,000. So what's the difference? The difference is that we can pool several investors together. So we can syndicate them. So if we take 10 investors, each of them can invest $25,000 and we'll be issuing a product for $250,000. If what I'm telling you seems to be a bit magical, this is not the case. If you see magic in finance, do not invest. Magic doesn't exist in finance. It's all about numbers, right? However, there are things to keep in mind. The number one is the credit risk of the issuer. Remind you, I told you that a structured note will be issued by a financial institution. Buying the product is exposing you to the credit risk of this issuer, which means if the institution goes bankrupt, you will be losing your money. And I'll go over how we select the financial institution that we work with to reduce this risk, to a minimum. Number two, the secondary market, something very important as well. When you invest into the product, you can sell the product on a daily basis. There is daily liquidity on the product. However, if you do so, and depending on the market timing, you might incur a loss. But if you want, you can sell the product. You're not locked for the maturity of the product. Buy and hold strategy. Following my second point, the contract is designed to be achieved at maturity. So if it's a 2-year product, you're supposed to hold it until the 2 years. And that's going to be the reason why you want to hold the product for 2 years, because the contract has an objective for a 2 years investment. So the financial contract, you know what I told you, it's a contract, there's no human bias. It's going to be executed only at the maturity. If you sell it before, you can get your money back, but you might incur a loss depending on where the market is. Number four, growth or income. I generally talk about income generation because this is what most investors are looking for. However, it's definitely possible to create a structured note that will give you upside participation into a stock. Still with downside protection, but depending if you're looking for growth or income, structured note can be done on two things. So let's take a wish list. What if? What if we could make Amazon pay a dividend? Because unless you don't know, but Amazon doesn't pay a dividend. And no one in the room, I believe, sits on the board of Amazon to change that, right? Or if you can enhance a stock's dividend. Microsoft is paying 1.42% dividend. What if it's not enough? What if you'd like to enhance this dividend rate? What if we could fix the income for the period? Remember what I told you at the very beginning? You might be buying a stock because you like the dividend, but you cannot control the fact that the company might cut it or might reduce it. General Electric is a very good example. Very, very well-known company. Very old and traditional business. Maybe a bit too old and traditional business. They used to offer 5+% dividend a couple of years ago, and many investors just bought the stocks because of the dividend. So not only the stocks went down quite a lot, but they cut the dividend. The General Electric dividend today is 0.4%, and there's nothing you can do about it. What if we could secure your investment even if the underlying drops, for example, 25% in 1 year? And that's the downside protection that the structural note is providing to the investor. If the product that you're selecting is investing onto a stock that's going to drop 20, 22, 24%, to be precise, 24.99% in 1 year, you would be losing zero. We would give you back your principal. However, if the stocks drop above 25%, for example, 28%, you would be losing 28%, exactly like you would have lost if you have invested into the underlying. That's why there is no additional risk investing into the structural note. It's providing you a buffer of X amount of protection, then the loss would be exactly the same if you had invested into the stock. And number 4, we can also include what we call insurance. It's technically called memory effect, which means if the income is not paid by the structural note during the lifetime of the product because the stocks drop below this 25%, we put this memory effect into account, so if the stock goes back up, you would take back all the remaining income that you have missed. Okay, now I'm going to try to get ladies' attention, and that won't be too hard. This is one of the most desirable companies in the world, run by the second wealthiest people on earth, Bernard Arnault, a French guy. Louis Vuitton, they make these amazing handbags desired by everybody that you can see in the street today, right? What if you want to invest into LVMH because you think it's a good company? You see it everywhere. Okay, you might be buying the stock, first option. Volatility, as I told you, and 1.62% dividend. Not so good return. What if you want to buy the bond? Long maturity, 5 years and above, and currently with the rates in euro, it's going to be a very, very low income. However, let's see what we could do if we design a structured product around LVMH stock. 1 year product, you invest in US dollars, even if the stock is listed in euro, you don't have to convert the currency. The currency is embedded in the product. 25% downside protection, monthly income, 5.35 guaranteed coupon per annum. This is actually a pricing that I ran yesterday, so it's very accurate, okay? What's gonna happen? Let's talk about the positive scenario. Every month, you'll get the income. So in my example, it's 5.35% divided by 12. Every month, you'll get the income on your bank account. Let's see what happens at maturity. At the end of the 1 year period, the stock drops 12%. If you had invested into LVMH, remember, you would have 1.68% income, and you would have lost 12%. No protection. The structural note in this case is giving you a 25% buffer, which means in this zone, you're in the protection zone, you will get back 100% of your principal. Okay? Let's talk about the negative scenario now. Same thing. Every month, you get your income. The 5.35 divided by 12, every month you get the income anyway. But the stocks goes below the protection barrier at maturity. For example, 28%. If you had invested into Louis Vuitton buying just the stocks, you would have lost 28% plus the 1.68%. In that case, you're also losing 28%, but you receive the income of 5.35. So your loss is only 22.65%. I'm not saying that a loss of 22.65% is nothing. I'm just saying it's a better investment than the underlying directly. And that's what the structural note is designed for. It's designed for providing protection versus the income that you can generate. However, we could have said, not after, but before starting the product, let's take a 30% downside protection, or maybe a 40% downside protection. 2 outcomes. First, we would have reduced the income to compensate for the more deeper protection, or we could have extended the maturity to make it a longer investment, to allow the stock to rebound. Okay, now that's my turn after Igor to talk about what's going on today. I believe you know all these words, right? They are all across the news. You turn on the TV. This is the only thing people are talking about. I start with one of the most famous people in the world today for good or bad reason. I'm not going to debate about the guy itself. If this guy wakes up in the wrong side of the bed, kind of, He's not going to jump on his phone, but he's going to tweet something, right? And if he's going to tweet something, the market might move. Up or down, I don't know, but the market will move. China. We know that there's a trade war going on between China and Trump, right? This affecting market, this is affecting the currencies as well. When you affect the currencies, there's an impact of oil. The price of oil is very much linked to the price of the US dollars, right? Also, if there is a war, a simple war going on between Iraq and the US, for example, the price of oil will vary, right? Talking about currencies, currencies are very linked as well to the policies of central banks, whether it's the Fed or another central bank, okay? So they've been cutting massively their rates over the last few years, whether it's the Fed or even the European Central Bank. And when you cut the rates, the currency is less attractive, so the currency will devaluate as well. When there is panic on the market, volatility, people tend to buy gold. Gold is considered a safe haven, right? It's a non-productive asset, but people like to buy gold because they feel comfortable. They say, okay, I have gold bars in my safe, I feel comfortable. Even if I'm losing money on a daily basis because there is inflation on the market and people don't really consider that, they might be buying gold. I'm not going to talk about Brexit. We had a very expert view on this before. What I want to say about this today is there a global recession coming up? And I'm going to give you the answer. I don't know. And it's not the problem. The problem here is not to say, am I right, am I wrong? We've been sharing thoughts with the speakers yesterday. It's been very insightful. There's a clear view that the media would like a recession to happen because they would be selling newspaper, people would be reading news, people would be buying stuff, and people would be scared, and when you're scared, you want to be reassured, and you're buying things just to know what's going on. I'm not criticizing the media, I'm just giving you a view of what's happening. However, if you're being factual, like Igor was, you look at the numbers. Yes, maybe some numbers are not as good as yesterday, but they are still strong numbers. If you look at unemployment rate, if you look at the PMI index, all these very technical stuff that you don't follow on a daily basis. But when we look at the numbers, the global economy is doing okay. So why would you want a recession to happen just for the sake? It's not because we've been on the longest bull market ever that the recession have to come. It might come, it might not come. The only thing that you have to bear in mind is how to navigate, and that's the theme of today's symposium, how to navigate the market. You have to take decision. Okay, you won't withdraw all your money from the bank and put it on your safe at home. Very dangerous. If someone sees you, might not be a good solution. So, first assumption, yes, there's going to be a global recession. Okay, but with the structure note, you have this downside protection. The idea is how much protection do we have to set for you to be protected in case the market drops. And you don't want to take as well a too long maturity investment if the market keeps dropping. Number two, no global recession. So you have to keep investing. You're investing in the market because you bought the product and the product is behaving itself and is not managed by anyone. The product lives just its life. And you benefit from the regular income stream. Okay, third assumption. Yes, again, global recession. Okay. You might use the income that you're getting on a monthly basis to buy equity. And you're buying the market cheaper because the market is dropping, and you just have this opportunity cost to buy the market cheaper and cheaper. If you are not investing into the market, most likely two things going to happen. Number one, you don't want to invest. You say it's too high. And it's going to keep higher and higher and higher, and you will never invest because it's too high. And then you have an opportunity cost because you have inflation. So you're basically losing money on a daily basis. Other scenario, the market will drop and you'll get scared and you won't invest because you say, oh, the market is dropping, I cannot invest. Maybe it's going to drop lower and lower and lower. So how to navigate the market is trying to understand, what parameters do we have to set in the product for you to feel comfortable, navigate the market, closing your eyes, okay, not ours, because we keep looking at the market, but closing your eyes and to make sure that you are comfortable with the downside protection provided by the product and the yield that you're getting for the risk you're taking. And the last point that I mentioned a bit is opportunity cost. Not investing today is creating for you an opportunity cost. What do you do with this money? If you diversify your portfolio with real estate, for example, it's a very good thing. But if the portion of your money that you're supposed to invest into financial market for diversification stays in the bank account, you're losing money on this sleeping money. So let me tell you very quickly how we work with Persian today and what have we done so far. We start from the investor needs. And I don't talk to you on a daily basis. You talk to your 29K financial advisor or to your team, and you're expressing your needs when you meet, right? So what we do, we start with a blank page, and we take the wish list. Prashant will tell me, investors are looking for X amount of return, and they will feel comfortable with X amount of protection over 2, 3, 5 years. So we'll take all this wish list. Then we have to select the underlying. What do we invest into? Because the product, as I told you, is linked to an underlying. We don't pretend to be the best, and we are certainly not the best in selecting the stocks. However, in every single bank in the world, you have what we call an analyst team. People analyzing company on a daily basis, and these people are hundreds of people, couple of like dozens of people on each bank, so like hundreds of people. What we do is we take all of them. We take all their advices, all their data that we select, and then we go by filters. We invest only into big companies. We reduce the volatility target. We make sure that all of them, or 75% of them, is positive on the outlook of the stock. We look at all these different data to select and to do the stock picking. Then we do some structuring. This is the technical part that I'm doing. We run some mathematical financial tools to see what we could offer to the client. And then I'll come back to Prashant and I say, listen, we have selected these stocks. We can offer 37% downside protection over 18 months with an 8% return. And Prashant will tell me, no, Greg, my investor wants 40% downside protection. Psychologically, they feel comfortable with 40%. Okay, I'll run the financial models and I'll come back to him and say, listen, if we extend the maturity to 24 months, we might have to, launch the product because we can have 40% downside protection, 8% return on this specific basket of stocks. And the best execution is when we put all the financial institutions we work with in competition to deliver the best price. In any kind of business, when you want to buy something, you put people in competition for them to show their best price. So we do the same. We are not linked to any financial institution. Once we have all the criteria of the client, we just put them in competition for them to show their best price. Very quickly, the track record that we've done with Prashant so far, more than 25% launch. We are launching pretty much one product a month currently. Average return 8.5%. Average downside protection and coupon trigger 40%. We usually invest into a basket of 3 to 4 stocks. Average maturity of the investment 3 years. We've done shorter recently because of this potential global recession. We've shortened the maturity a bit. And we can also include features such as the memory effect that I told you, and also autocall, which is a bit complicated to explain, but basically we put some features in the product. If the market starts to overheat and all the underlyings are going up too much, the product is early terminated, you get back your money, and we can reinvest into different underlyings if the market starts to overheat. Very basically, this is what Prashant is following on a daily basis. This is the dashboard. We make sure that we follow what's invested in. I wanted you to close your eyes. Of course, we don't close ours, so we keep track of everything. The diversification of the portfolio geographically, in terms of sectors, in terms of data, we track everything on the portfolio. That's my favorite slide. Usually I don't say anything because it speaks for itself. You must know 90% of the companies that we have invested in. So nothing specific, nothing too exotic. We invest into solid and very reputable business. This is all the companies. Maybe I'm missing some of them. The main companies we've invested in. And these are all the financial institutions we work with. When I told you about selection of the financial institution, we'll make sure that we run a credit analysis on each of the financial institutions we work with. Which means currently, to tell you, we don't work with any Asian banks. Just because. Nothing against them. The trade war, we don't know how it's going to end. Not sure we really want to invest into Asian banks. For example, we don't really invest into Brazilian banks, for example. Still the geopolitical tensions. And we don't really invest into Deutsche Bank, for example. Deutsche Bank is in a bit tricky situation, I would say. So we make sure that we select the best banks because they're going to be issuing the product. And as you understood, you also have a risk on the credit risk of the institution if this institution goes bankrupt. So we make sure that we do a careful selection on the issuers of the product. That's very quickly what I wanted to say about the product. It's been a bit intense, a bit dense. I get it. So very open to questions now or after the presentation. But again, to sum it up, it's all about listening to you and creating a product which is according to what you're trying to achieve. Thank you.